Hey guys, what's up? Alec back with the daily stock market, and today we're going to be doing a quick video of the best swing trades to look for the rest of January and into February. So the first one up on the list, we have ChargePoint. Make sure you smash a thumbs up before we get started on this video. But we have ChargePoint down to $17 per share, down 12% in the past week. Okay, now it just recently in November, second half of November was at $27 per share. It's down 38%. And if you're looking at TA in the last 12 months, you can see that right around $16, $18 per share is typically a support. Right now it's below the support, so it could be a good little swing trade here back over $20 per share to $22, maybe even $23 per share. Now, most of these swing trades, you guys know how I like to do it. They're going to be good long-term holds also. So we have analysts in the last 3 months putting in their price alerts for the next 12 months, and they agreed that about $29 per share, 76% upside on ChargePoint's possible. I think that could happen in the next 3 to 6 months. Just understand that this one has large risk involved with it, and most of these swing trades on the list have large risk, so keep that in mind. But with large risk, there is higher reward. And at $16 per share, I think the risk versus reward ratio is definitely worth it. Under $17, closer to $15 per share. All right, and the next one up is Robinhood, down to $15 per share. I know a lot of you guys don't like Robinhood, but they have crypto wallets coming, and they're probably going to be adding Shiba coin soon in January, February. They're actually supposed to be releasing crypto wallets in January or February, so that could be a great catalyst after the stock has been beaten down 61%. So keep in mind, we like to look for the stocks that have been beaten down a lot so we can swing trade them back up. We have Robinhood down all around 80%, so it does have to recover at some point. And keep in mind, a lot of stocks, once they IPO, they typically go down for a few months. Like Facebook is a good example of a stock that went down after the IPO. Robinhood, obviously, there is a lot of risk involved, and you have to have a risk tolerance for something like Robinhood. But I think there can be a lot of percentage gains to be had with Robinhood shares. Analysts have a huge upside for Robinhood, 155% over the next 12 months to $39 per share. And you can see where these analysts are coming from. Most of them are 5 or 4 stars, JP Morgan, Bank of America, Wolf. Now, those ones are a little bit lower, saying $22 and $17 per share, okay? But on average, they're saying $39 per share. And you can see there's a lot of different analysts that are coming in and ranking 14 different analysts. And on average, they have it right at $39 per share, 150% over 12 months. And don't forget, Robinhood has the potential to become a meme stock again, and the list meme coins like Dogecoin, which can give it a lot of power, and Shiba coin. Investing in a meme stock carries unique risk, but it has granted successful companies cheaper access to capital and greater public awareness in their quest to reach critical mass. All right, further backing from popular ETF manager ARK Invest could be an important catalyst for Robinhood shareholders, as they have demonstrated successful picking winning companies. Speaking from ARK Invest, the heightened trading activity was possibly a result from the further backing it received from popular ETF ARK manager ARK Invest, Cathie Woods. ARK is no stranger to the power of retail investor enthusiasm, and their continued endorsement of Robinhood during its recent pullback is noteworthy. I have previously written critically about the extreme valuation for their flagship ARK, which is ticker symbol ARKK, but ARK's long-term track record of picking winning companies is something to take note of. So not only does it have swing trade ability up to around $24, $25, even $30 per share, but it also has long-term ability to around $40 per share in the next 12 months, according to analysts, and also according to Cathie Woods, because she keeps loading up shares for her long-term flagship ARK ETF. So I'm sure she believes that this is a $35 per share stock or higher. All right, so the next one up is a fan favorite. We're talking about SoFi Technologies, ticker symbol SOFI, down significantly, down 18% in the last 3 months, and down 40% from recent highs. Here we can see a nice swing trade pattern consistently performing around $14 per share, $15 per share, $16 per share. When you buy at these levels on SoFi, you continuously get rewarded by swing trading above $20 per share and selling right around $18 to $22 per share in that ballpark. We've done it many times in the past, and I think we'll have the ability to do it again. Riskier traders could even look into some option trading for SoFi. Also, long-term investors rejoice. This one might be the most fundamentally sound that we've talked about so far, and analysts have a 76% upside in the next 12 months to around $24 per share. And if you're able to swing trade it from $13 per share all the way to $20 per share, you're going to be looking at around a 50% upside on a swing trade. Okay, so here we see a summary of SoFi as leading the crowd race to super app nirvana. We discussed why super app stardom is a prize worth fighting for and why only SoFi is structurally stronger than its peers. A looming SoFi catalyst is an approval of the bank charter. I highlight the impact of this charter on SoFi's business and how a financial service company can achieve 90% margins, which is absolutely insane. Loan refi landscape is dynamic and changing. We evaluate how the recent repayment extension impacts SoFi's profitability. SoFi is a cheap stock. The fintech continues to make great progress towards approval on the banking charter that will save up to 200 basis points on loan costs and improve revenues. The stock is too cheap, trading at 10 times original 2024 adjusted EBITDA targets. Okay, despite a very promising start, SoFi now trades back to where the stock traded at the time of the SPAC transition last May. Fintech app was a buy the last couple of times the stock fell below $15 per share, and nothing has changed. My investment thesis remains bullish on SoFi, now down to $13, following a nearly 50% dip after multiple trips above $24 per share. SoFi isn't perfect and hasn't had the perfect history as a public company. The fintech came out the gates reporting Q3 2021 revenue targets far below analyst expectations, waiting on the bank charter. Okay, considering the dependence on capital to finance their lending products, the pending bank charter is crucial to the long-term success of SoFi. The fintech needs bank deposits from members in order to fund the future loans similar to traditional banks. At the recent Credit Suisse Technology Conference, CFO Chris Lapointe repeated the benefits of the bank charter. The company is optimistic at obtaining full approval, which I definitely think will happen and could be a huge catalyst for a swing trade or even long-term holders. In terms of benefits of having a bank charter right now, it comes in multiple fold. Primarily, it's a cost and capital play and will allow us to grow our lending business in a more robust way. So to give you a little bit of a context, our lending business right now we rely on is about $6 billion of warehouse capacity as well as our own equal capital in order to fund. Okay, so the takeaway basically, the key investor is the SoFi is far too cheap and down to the lows. The fintech has a major catalyst, is an already fast growing business, and yet the stock trades as the business has been impaired. The stock is now trading around 10 times original 2024 EBITDA targets. Okay, assuming the bank charter is approved, investors should buy the stock ahead of the bank charter approval before the moratorium on the student loans expire, allowing their lending business to return to normal. So in my opinion, this will be one of the last times that we'll ever see SoFi under $15 per share, especially with both those catalysts with student loans coming up and the bank charters. I think it's a good time to load up for swing traders and for long-term holders. That's just my opinion. All right, the next one up that we're going to be talking about for the swing trades of 2022, you got Palantir on the list. All right, Palantir is another fan favorite, down 30% in the last 3 months and down 38% from recent highs. From all-time highs, it's down closer to 60%. Okay, this one was a good swing trade company that we have done in the past. But now it's broken far below some supports and resistance that we've established before. Here we saw it bouncing off this support and resistance a few times. However, this time it started going down and it's basically in a free fall mode. All right, there's no supports anywhere close. The next one's down to $10 per share. However, I think it's going to be bouncing and setting a new support, just like we saw in May 2021. We saw them establish a new support under $20 per share at $18 per share in the past, which it hasn't done clearly before. Now, we even almost saw an uptrend in Palantir here for a while too. All right, so when everyone saw that Palantir wasn't going to continue up on this trend and instead head down, that's where a lot of people ended up losing money on Palantir, which already happened. And for the buy the dippers that haven't gotten to Palantir yet, it could be a good time to pull the trigger. Now, if we look at what analysts have to say, they have a modest 33% upside, which is still great for Palantir. I think a swing trade the next 3 to 6 months can yield around a 20 to 30% gain to around $20 per share is my personal price target on Palantir. If you want a quick summary on Palantir, has a steady and sustainable revenue growth. Palantir has high gross margins, which is great. Palantir has a history of losses, which is bad. Palantir is significantly diluting shareholders, which is bad. In this article, I combined all these factors. Palantir is a great example of how it is to value high growth companies. Palantir is growing revenues 20 to 30% annually, which is spectacular and what you want to look for in a growth company, and has appealing gross margins above 70%. Anything above 50%, to put in perspective, is a superstar company. This one has 70%. The company also has yet to generate net income and is increasing its share count to 10 to 15% annually. So you want to understand, if you're looking into Palantir, where is all their money going since they're such a highly profitable on gross margins? Extreme bears point to a long history of net losses and accumulated deficits and say that the company is worthless. Extreme bulls argue that the high revenue growth rate means that the past doesn't matter and that traditional valuations shouldn't be applied to PLTR. I think the answer lies somewhere in between these two viewpoints. In my last article, I looked at some of the valuation scenarios using the FANGM companies as a rough benchmark, which is Facebook, Apple, Amazon, Netflix, Google, and Microsoft. In this article, I will present an updated valuation model, take shareholders' dilution into account, and I will use the model as a walkthrough viewpoint scenario. Revenue growth rate management has guided 30% annual growth rate or more through at least 2025. Wow. The company was able to grow revenues by 25% in 2019, 40% in 2020, and is on track for 45% revenue growth in 2021. So it seems like a fair estimate to me. I am willing to accept a 30% estimated annual growth rate over the next 4 years. PLTR is expanding their non-governmental product offerings and thus gaining exposure to new markets and customers. PLTR products and services aren't easily compared to competing offers, so PLTR has room to raise prices if their customers are generally satisfied, and expanding its customer base and ability to raise prices both support sustainable revenue growth and also will give them into higher profitabilities and be able to become a profitable company easier as well. All right, and the last stock that we have to talk about under $20 per share is going to be FuboTV for a swing trade. And I think that this one can be a pretty good swing trade, down 43% in the last 3 months. All right, and just from recent highs, this one's down 58 to 60%. and from all-time highs, they're down closer to 70%. All right, this was also a swing trade that was following a pattern just like the last one that we were talking about. All right, and then it moved downward very quickly outside of the support and resistance that it was following here. All right, so we saw that support and resistance following and hitting a few points here, but then all of a sudden we saw this downward movement here that really took investors by surprise, and a lot of investors lost a lot of money with FuboTV. However, if you haven't gotten FuboTV yet, think under $15. This would probably be one of the last times to get in under $15 per share. And if you're getting in at $13 per share, I think that's going to be a very beneficial time, because I think 100% swing trade is definitely possible to FuboTV right around $26 per share. However, I will be offloading some of my shares above, even above $18 to $19 per share. If we look at what analysts have to say about FuboTV, here we have 195% upside to around $41 per share. We have on average the analysts projecting, and the lowest analyst we have at $28 per share. Okay, this is based off 9 different Wall Street analysts, and coming from Roth Capital, coming from Needham, coming from JP Morgan, all at $28 per share. We even have one coming in at $60 per share. So it's interesting where these analysts think that FuboTV is going to be heading up and growing to. Now, I do want to say there is huge risk with FuboTV because they might not, going to anything, but they're focusing on sports programming. You can read a little summary there. The investment thesis is a virtual multi-channel video programming disruptor platform. It focused primarily on sports streaming as part of its key content and engagement strategies. Think of it as kind of like the sports of Netflix, the Netflix of sports. The company believes that the cord-cutting move towards sports streaming is still in the early innings compared to entertainment-focused peers. Even though FuboTV has a wide content slate, they believe that the key driver of its growth lies in sports programming and online sports betting. Although FuboTV is still an emerging leader in the space, it has gained significant traction. Moreover, the large majority of its subscribers are also sports viewers, lending credence to its strategy. However, the company's road to profitability looks to be further extended. Consensus estimates on its adjusted EPS has consistently been revised downward through 2021. All right. Moreover, it also has been a favorite target of short sellers, with its short percentage float consistently in the double digits. Therefore, we believe that Fubo stock is suitable only for speculative investors. So remember, that's very important. Only for risk-tolerant investors who have the tolerant significant volatility in their short to mid-term. We discuss whether it's a good choice, and here we can see that it's unlikely to report EBITDA profitability in the near term. There's little doubt that Fubo has increased the revenue remarkably over the last few years, reaching 150 million only. You can read some of that as well. Fubo stock is currently trading at a revenue multiple of only 2.4. Many investors consider that Fubo stock is really cheap since its speculative momentum spike completely fizzled out. However, its TV peers, who also have been in the space and the business, are also trading at relatively low valuations. So you can continue to read some of that as well. Its resistance levels in 2021, which were around 8 times revenue levels. Therefore, we believe that investors must understand that FuboTV has huge opportunities and they are long term, and the company is unlikely to report a profitable EBITDA in the short to midterm. Moreover, the stock is a favorite of short-term sellers, so there's a lot of risk involved with the short percentage float exceeding 20% this year. Currently has a short percentage float about 15%. So I hope that helps you make a decision on what kind of swing trades that you're going to be taking out in January and February, and maybe you pick one or two from this list that I have here. all right, and look a little bit deeper into them and do some of your own research. If you like the way I talk about stocks and want to hear a little bit more in detail of when I'm buying stocks, how much I'm buying stocks, and live access to all my trades and when I'm selling and how long I plan on holding for, make sure you message me here on Instagram, the Daily Stock Market. I read through all my Instagram DMs, so if you need help and someone to mentor you and take you under their wing, I have the perfect program that has helped hundreds of other people just like you in the past. If you want to see for yourself, read success number 4 or success number 3 or success number 2, and there's hundreds of highlights of students or beginners that didn't understand the stock market at all that I've helped get to a more advanced level at understanding the stock market and making money through the stock market. And now is a perfect time with the stock market down. Buying the dip is one of the strongest things you can do in the stock market, and we learn about that in my program as well. So guys, make sure you like this video, share with a friend, subscribe on YouTube for all the full-length videos for absolute free. Just hit that subscribe button and the bell icon so you're notified whenever I post a new video. I'll see you in the next video. Remember, don't time the market, buy the market. Peace.